Hello, and thank you for joining us today for our ePractice Manager webinar with our special guest, Elliott Tracy from Jones Roth CPA Group. Today, Elliott will be speaking about what to expect on taxes and accounting for 2022. Elliott Tracy is a partner and key member of Jones Roth Healthcare and Dental team. He specializes in providing dental and medical practice owners with practice benchmarking, cash flow planning, business strategy, and tax planning. Welcome back, Elliott. It's so great to have you.
Yeah, thank you, Sarah. And I'm glad everybody is jumping on today. Look forward to talking to you all. I got a few list of topics here we're going to go over and, try to stick to what we're expecting for the year, but also kind of not trying to do too much crystal ball looking, because I think we're going to have a little bit of that. So we'll try to stick to what we have that we know, and then the things that we're that we're kind of expecting. So let's get right into it. I wanted to start off. So as the title suggests, taxes were going to be kind of a big conversation of this webinar, with a few things scattered in there and a couple of other areas. But really, we've got two key tax bills right now. And the first one, the Infrastructure Investment and Jobs Act, this was passed back in November of 2021. And there's not a lot of key tax provisions in here. There were a few things. One of those specifically, I think the most popular was the removal of the employee retention credit as of 9/30 of 2021. And we'll talk about that here in a minute. That's actually a topic I'll discuss towards the end of this presentation. But we're going to spend a little more time on what has been referred to as the Build Back Better Act, but more specifically, kind of what its status is, what things are within it, and some of, maybe a few expectations that we have, but trying to be pretty conservative there because, that passed the House. I believe that was November 19th of 2021 and went to the Senate. And then you'll probably all remember, you probably all saw in the news that moment where it got shot down, and it didn't have all of the 50 Democratic votes that it needed to get through the Senate. And this thing has kind of stalemated since. There hasn't been any revisions to it. There hasn't been any additional discussion about it. I mean, we'll say they all have had plenty of other things to think about over the last 2 to 3 months than just this tax provision and bill and those things. But just a reminder, so Build Back Better, there was a lot of stuff happening in that. And a couple of the key ones, so there was going to be some tax increases, but the major purpose of this act was really funding for things like climate change and healthcare spending and additional paid leave and other items that specifically they wanted to fund with some tax increases. But it was going to have a pretty significant budget hit. I think it was about a 3.5 trillion was the initial spending bill. So I won't spend too much time on that. I want to jump in and kind of just talk about some of the key provisions of this. As I mentioned, so this is a potential bill. It is absolutely not final at this point. And really, like I said, there's been kind of a stalemate up to this point. So kind of glance through that, but I want to talk about a few of the key provisions just that kind of fall within each of these different areas. Talk about what was originally in the bill and then what was kind of removed from it, and then what's still sitting there that we do definitely have some concerns about. And I'm going to try to highlight the things that I see that are really most concerning to me, and then for you guys as dental practice owners or practice managers or whatever your role is. So on the individual taxes, the question of what's in and what's out. One of the things that was in is this expansion of the state and local tax deduction, which commonly is referred to as the SALT deduction. In 2018, with the Tax Cut and Jobs Act, that itemized deduction for state and local taxes was reduced from whatever you actually paid for the year down to $10,000 cap. And so that the most you could deduct for your real estate and state taxes was $10,000. So depending on which state you were in, this had a much larger impact than other states. And I'll give a few examples. California, Oregon, both have pretty high income taxes. Washington has zero income tax. It's only a sales tax. Idaho has a very small income tax of about 3 to 4%. And then there is a sales tax. New Jersey, New York, a lot of these other states, they had also very high state taxes. So, and if you were a resident of one of those states, you saw a pretty big impact from this. Couple of the other things we talked about, what's in, that is an item that's in. What is out is the capital gain, or what is out was this discussion about increasing capital gains rates to the same, to what could be considered the same as ordinary income tax rates if you are towards the top brackets. And I know that caused a lot of folks, I saw a lot of this, we actually saw some pretty accelerated decisions of selling dental practices as a result of out of this concern that maybe this would pass. And instead of receiving capital gain treatment on those, on the sales of goodwill, we were going to see some ordinary income tax rates, which would significantly reduce the actual amount the seller would be seeing from that piece. But at this point, we've seen that go away. It's not something that we're overly concerned about at the moment. But again, future revisions could bring some of these pieces back. One thing we are fairly concerned with is this expansion of the 3.8% of the net investment income tax. I'm going to try to be very brief in this, but the net investment income tax has been around since 2012. It was part of the Affordable Care Act that was passed. And specifically, what if you had passive income, meaning income you weren't active in. And so that generally was things like potential real estate investments, interest, dividends, capital gains, not things you were active in, which was your dental practice. That 3.8%, if you hit in certain income levels, it was added as an additional tax on that investment income, which essentially increased some of that from maybe a 15% capital gains rate up to the 18.8%. The discussion here is that they want to expand this 3.8% across active entities. So whether it's a partnership or an S corporation, that 3.8% would be on top of the normal federal tax you would pay on your net income from that activity. Based on what we're currently seeing, that would kick in if you were married filing joint with about $500,000 of adjusted gross income and a single individual of about $400,000. So they're fairly low thresholds considering what we see across some of these dental practices. And so that was a big concern. The cryptocurrency continues to be a big piece as well. Really, the main thing I want to mention there is that they're trying to impose a lot of the normal stock type sale rules to this. So actual reporting of it, requirements in terms of 1099 reporting, wash sale rules, and things of that sort. So those are all concerns. The administration feels like this is a lot of lost revenue in terms of crypto transactions. And that's because there's just not a lot of oversight. And so they don't really know what transactions are happening. And those are a few of the key pieces that we'll see, but a couple of the other things that I just want to mention. So this kind of goes business and individual. A couple of things that are out. We currently have not seen a discussion about, I mentioned the capital gains and dividends, but corporate tax rates. So if you're a C corporation, we're not expecting those to be adjusted. We've had a 21% flat tax rate for the last few years if you were a C corporation. At this point, we don't see that changing, but there is a discussion about adding a new alternative minimum tax, which would add a minimum of an 18% depending on what your taxable income was. And that really was, if it was, I think the discussion was around the $400,000 in taxable income in a C Corp, which we don't see a lot, but because most of those are zeroed out, but there is a discussion. And again, just kind of flipping back and forth a little bit, the individuals, we are not currently seeing an increase in those rates. A few other items that there are some discussions about, the qualified business income deduction. So that is a 20% deduction on the income you have from either a partnership or an S corporation. So if you had $100,000 of net income from an S corporation, there would be a 20% deduction or $20,000 that would be included on your tax return. It didn't cost you anything. You didn't have to spend anything to get it. It would just show up. Now, for businesses like accountants, dental offices, attorneys, we had some very special thresholds. And so if there were certain income limitations that were met, a lot of that QBI deduction was phased out. And that QBI deduction would be fully phased out if your income got to about the taxable income got to about the $430,000 range. That discussion would completely go away, or that deduction, would completely go away. They talked about expanding those limitations more heavily on all businesses. So not just what they consider to be the specified service trader businesses, the accountants, the dental offices, the healthcare providers, and the attorneys, but to other businesses as well. So construction and real estate and architects and engineers, all of those were also going to be covered under the same limitations. This would have taken away a significant amount of deductions. And not any big change here for the dental world, because you get those groups, you guys were already kind of subject to those limitations and were maybe missing out on those things. There's a few of the big business items. I already mentioned the early termination of the employee retention credit. That was supposed to run all the way through the end of 2021, and it was cut off on 9/30 of 2021. There are a few changes in the retirement world. A lot of these, there were some issues, or not issues, I wouldn't say, but changing limitations with when or not you could do things like Roth conversions. And so there's a comment there of no Roth conversions for high income taxpayers. A lot of these provisions that were added have pretty high thresholds, and that really isn't going to kick in at this point until 2028. And so a lot of this discussion has kind of been tabled as a result of it. There's nothing really to be concerned about at the moment, but there certainly are some things on the horizon that the current administration is trying to really minimize. One of those specifically was, if you had an IRA that had more than $10 million in it, then you were prohibited from making any additional post-tax retirement contributions, which are referred to as Roth. There were also some provisions within there that would require a certain minimum distribution if your IRA did go over $10 million. So a lot of these things were actually originally proposed in 2022, but there were some adjustments to it, and now none of those things would actually kick in until 2028. Again, this would actually have to pass for any of these rules to go in place, but be aware that is there and that there is a potential. It is definitely a target of the current administration is the high IRA balances, and especially high Roth IRA balances. And the main reason there more than anything is Roth IRA is a great inheritance tool, because the individual who's taking it out can take it out tax-free, just like the original owner would. But specifically, with a traditional IRA, usually what happens when that if somebody passes, it becomes an inherited IRA. That person then has to take that balance out over a certain period of time, and it a lot of times can be taxed at a higher rate than the person who actually passed with that IRA would have paid if they had taken all of that amount over their lifetime. So the Roth IRAs are being targeted for that reason, specifically because of that inheritance nature to it, and the fact that they're all post-tax dollars. So let's see here. Other considerations, we talked a little bit about this SALT deduction. One of the key pieces I really just kind of want to discuss here for a moment is there are certain states, Oregon being one of those, Idaho, California, a lot of states have imposed what we call state and local tax workarounds. What this means is that if your state or if you are being limited by the amount of state and local taxes you can deduct, the state was creating this workaround that allowed your dental practice itself to pay the state tax on your behalf. And the reason this is extremely beneficial is because now, instead of missing out on what could be a pretty large chunk of these deductions, it was shifted onto the return, which is a page one reduction that reduces AGI. And AGI affects a lot of different limitations, including the QBI deduction, and a lot of other pieces. So it was going to add a pretty significant amount of benefit to certain individuals. Excuse me. I'm not going to go specifically into because a lot of different states are doing things differently in terms of how they're handling this workaround. But what I think I want to at least mention is that a lot of these states do have this workaround. If you're not aware of it, you should talk with your tax advisor, and they can kind of walk you through if you have this benefit or not. But specifically, and I can speak to Oregon, for example, and other states, within their workaround, within the law, they stated that if the SALT cap was changed, so if the SALT cap was increased from 10,000 to 80,000, and 80,000 is the number that's actually in the Build Back Better. They talked about increasing that limit of itemized deductions from 10,000 up to 80,000, which would allow a lot of you to actually take that as an itemized deduction again. So the laws that a lot of these states put in place when they had this workaround was that if the SALT cap was increased, then this benefit would go away in terms of this benefit of having the entity pay it on the individual's behalf. So I think that's it's just something I want to make sure talked about, and give us a couple of specific examples in that area. This is kind of a side note, but other considerations. The Build Back Better Act, one of the pieces to it was there was going to be significantly increased funding to add more IRS auditors. The IRS in general feels that there's just not enough people for them to keep track on compliance wise. And so they think a lot of returns are done incorrectly, whether inadvertently or intentionally being done incorrectly. And that by increasing the number of auditors, they feel that they'll capture more of that lost tax revenue, which will help with some of the funding of this Build Back Better Act. That's kind of the main piece with the Build Back Better Act. I wanted to go over, kind of covering really the high pieces that I felt like this group would be impacted by. But again, we went over a lot, quite a few things there. Went over a few things pretty quickly. And more than anything, just want to mention that it is currently not a law. We don't know when it will be, and we don't have an expectation of when that'll happen. Most administrations do like to leave their mark on the tax law in some form or fashion. And so there's an expectation that something will happen over the next couple of years, or maybe even later this year. But just, it's hard to say when that's actually going to take place. And so I just want to kind of end with that piece on that act. One of the other tax pieces I want to mention, and I feel like this is still a very missed thing, that a lot of new offices that I either talk to or have reached out in some form or fashion. This is something I think a lot of offices haven't taken advantage of yet, and it is there. It is the employee retention credit. The employee retention credit is a credit that refunds payroll taxes that were already paid. But I'm going to go through just a very brief history of the credit itself. So the credit came about as part of the CARES Act in March of 2021, right after really COVID kind of made its biggest impact, when we saw offices being shut down. We saw these government mandates for shutdowns of non-essential workers and such. And what came out of this? So at the time, you had the option of either choosing to do the employee retention credit to receive refunds of payroll taxes, or to get PPP. 99% of everybody I worked with went for the PPP. And a lot of that was, it made sense. It was a lot easier. The money was going to show up faster. And I think that was everybody's concern. So therefore, employee retention credit kind of went away and nobody looked at it at all. Then in December of 2021, I think it was around that point, December or January, there was another bill that was passed, and that bill allowed business owners and practice owners to take the employee retention credit even if you received the PPP. What you had to do is you had to bifurcate the wages between what was used for PPP and then what would be used for the employee retention credit. And so basically what we found is that there's a lot of taxpayers who would still be eligible to claim these credits against wages that were paid in between March 13th, which was basically, between March 13th, March 12th was kind of that first initial day of the shutdown, through the end of the second quarter of June 30th of 2021, because at that point, during that time frame, the office was either partially or fully shut down. If you were not partially or fully shut down, which there weren't many places that was the case, the other criteria that was needed was you had to show a reduction in income of greater than 50%. So that was a hard criteria to meet. Most offices I work with, almost all of them met the criteria of you were either fully or partially shut down by a government mandate. So how you claim this credit, in a minute, I'll talk really briefly about a few examples, but how you claim this credit is you look at the wages. So you get a 50% credit up to $10,000 in wages paid for the entire year of 2020. And again, we can't double dip on the wages. So if you, let's say you had 5 employees, just to keep it simple, during that second quarter, 2 of them received $10,000 in wages. So you're going to get a maximum of $5,000 credit on each of those 2 employees. If the other 3 employees didn't quite meet that, then it would be 50% of whatever amount that they were paid. That is then completed on a form 941. So you would file an amended 941, and note that has to be done. The deadline to do that is within 3 years of that initial filing date. So the initial filing date for a Q2 2020 941 would have been July 31st of 2020. So you really have until July 31st of 2023 to claim an amended 941. So that's kind of a quick example I wanted to walk through. I think for most offices, depending on the size, we saw, if it was 5 employees, we probably saw $16,000 to $20,000 in credits. An example I was just looking at before we jumped on here was an office with about 22 employees, and their credit was almost $73,000. They had a lot of employees who received close to $10,000 in wages. So the completion of 941s, the mailing in of that form, and what would happen with that. And so this is a piece I want to kind of emphasize. The credit is a reduction to the expenses that are paid for the year it was claimed. So you may amend today, get that money in 2022, but when you file for it on 2020, you actually have to go back to your 2020 personal and practice tax return and amend, excuse me, for those years. So this actually retroactively goes back and affects the income of the year it was related to, which is kind of an interesting provision. There were hopes the IRS would give us some type of safe harbor that says you either do it in that year or you do it in the year you actually receive it, but they have not provided any kind of safe harbor. So at this point, you do have to go back. I'm going to mention 2021 really quickly because this credit did extend through 9/30. Most offices were not fully or partially shut down by a government mandate in 2021. So that criteria is generally going to be out. And I have felt that it's going to be really hard to prove that there was a full or partial shutdown by a government mandate during 2021. But one thing we have seen is a quarter. And again, this credit in 2021 it is instead of being $5,000 per employee for the whole year, it's $7,000 per employee per quarter. So if you are eligible for all 3 quarters of 2021, you could receive as much as $21,000 in credits per employee. So something to look at. The revenue reduction that's required to be eligible is 20%. And that 20% can be viewed in 2 ways. You can either look at a 20% reduction from the immediately preceding quarter. So if you're looking at Q1 of 2021, if there was a drop in revenue of 20% compared to Q4 of 2020, you would be eligible. The other way to look at this, there was a safe harbor that said you could look at the quarter over quarter, or you could go back to 2019 and compare. So your Q1 2021 compared to Q1 of 2019 was a comparison that could be made. And again, if you were eligible in 2021, that would go on the tax return that is probably in the process of being filed right now. And you would pay taxes on, it would be a reduction to expenses, which essentially means you're paying taxes on that amount. I want to leave finally with the fact that most states do not tax the employee retention credit. So by claiming the credit, because there was no corresponding credit in the state, they are not taxing you on the refund that you are receiving from that employee retention credit. So wanted to talk about that. I felt like it was a missed tax incentive that some still have not claimed or have not seen at this point. Now, I'm going to wrap up with what we referred to as kind of accounting updates. More than anything, and not necessarily there were changes in laws, but what changes are we seeing? And I wanted to highlight a few specific things. And so we talk about benchmarking, and what is benchmarking? Benchmarking is that continuous look at making improvements to your practice. So we're looking at expense ratios. We're trying to find ways to improve profitability based on what is your ratio of wages to your collections. And that's just a very simple example. And so that is what benchmarking is. So what are we seeing in the sense of changes here? So most, across the board, a lot of costs are up. And I don't think it's any surprise that I say that when you go to the store, the cost of a gallon of milk or the cost of a dozen eggs is up. I think I saw most recently, inflation is up on average over the last, I think 6 to 9 months, or it was the last 6 months, of about 7.5%, which is pretty substantial. And so we're seeing costs going up, everything from supplies to shipping to other operating expenses. Those things are going up. Other trends we're seeing is wages. So I know it is extremely hard to hire right now. There has been a labor shortage across pretty much all industries. And to hire somebody, what they're demanding, and I use the word demanding very deliberately, what they're demanding is a much higher wage than we've seen in the past in terms of what you normally would be paying. And so we've been talking and really kind of talking how important it is of keeping staff, because if you're having to add 2 or new staff at a rate that could be $5 or even $10 more per hour than it was before, that's going to significantly impact that benchmarking. It's going to significantly impact profitability of these practices. And so how are we trying and how are we advising to mitigate some of these things? Across the board, at the end of this last year, we recommended to a lot of offices, and I know this isn't a perfect example, but it is something, if you have a large fee-for-service client base that is not insurance, so you're not tied to a specific fee schedule, we did recommend a lot of offices raise their fees at least 5% across across the board, and that was to kind of mitigate this rising cost that we're seeing. So I feel that it's very important that you're doing that annually, whether or not it's 5% every year or it's a smaller amount. It is important, and that is a way of mitigating the increasing costs that we're seeing. The other piece there is you really just got to keep an eye on what the spending is, and doing that benchmarking, maybe a little more regularly than you would before. Maybe you're looking at it monthly to see what trends you have in certain expenses, and trying to tighten the belt a little bit in some of those areas and, save some liquidity and keep profitability up. Those are a few things we're seeing on the benchmarking side. And, with that, it kind of wraps up my conversation today. I wanted to keep this brief and leave some time for questions if there were any. If you guys have questions, there's the question and answer box, or you can throw it in the chat, either one. And with that, I'm going to turn it back over to Sarah. Sarah, have you seen any questions come through, or did you have anything else you wanted to comment?
Yeah, actually, I do. I've got two questions here. The first one is, if I haven't applied for an ERC, how long will it take to get a refund, and how will it show up?
That's a good question. So yeah, we talked about filing the amended 941. When you complete that and you file it, the IRS has been significantly behind in processing those forms. Our understanding is it's taking anywhere from 6 to 9 months to process those. We're hoping that speeds up a little bit. And the main issue that has been so slow is that the IRS has been short-staffed. Just like everybody else, people are working from home. They're just not as efficient as they used to be. And as a result, we're seeing that pretty big impact to how long it's taking to process paper returns.
Okay, awesome. And then with the potential tax changes, should I switch away from a S corporation to a C corp or any other entity?
Yeah, so what we're seeing there is that all comes down to tax law, and there's a pretty significant concern that if you were to make that drastic of a change that's just purely based on what potential tax law is, I would advise you against it. Generally, you want to stick with the rule of thumb. Normally, an S corporation is still the most beneficial entity for dental offices in just the current form. Now, if that 3% safe harbor not safe harbor, but 3% net investment income tax does kick in and does become something that is a reality, maybe this is a different discussion. But at this point, I would not look to make any changes. I wouldn't make any drastic decisions just based on, potential tax law or things that might happen. And C Corps have their, specifically like with C Corps, it has its own issues to deal with, especially when it comes to selling a C Corp. It is extremely unfavorable to have the sale of assets in a C Corp. And 99% of the dental office sales that I see are a sale of the assets. And so when that happens, the sale essentially is taxed twice. It's taxed once at the entity level and taxed again at the individual level when dividends and or other compensation is paid out.
Okay, awesome. Okay, wow. That was a lot of really good information. Thank you. So our team has received some really great feedback from our clients that currently work with Elliott. So if you have any questions, we encourage you to reach out to him directly at Jones Roth. A little bit about ePractice Manager. We are a full-scale, full-service dental consulting firm focused on helping doctors grow their practices and provide comprehensive training for staff. And I'd be more than happy to talk to any of you about our services as well. But for now, Elliott, thank you again. That was awesome. And we will look forward to hosting you on another webinar very soon.
Yeah, thank you, Sarah, for having me again. I appreciate having the opportunity to talk with everybody and look forward to talking to you again soon.
Great. Thank you.
Thank you.